Hey guys, it's Lane with the Simple Passive Cash Flow Podcast. I got Tyler Shelf from the Cashflow Guys. And little trivia there, there's only one guy. It's only Tyler on that thing. You can check out his podcast at thecashflowguys.com. But thanks for coming on, Tyler.
Hey, thanks for having me. I got to tell you, there used to be two guys, but one guy just went into the insurance industry instead. So we're
Oh, well, you can make it like, well, the listener, that's the other guy. So
there you go.
I don't know.
There you go.
But yeah, so thanks for coming on. We've been working on a couple of projects together, and definitely want to get your opinion on a lot of this stuff lately that we've been working on, like the syndications, and you're still playing around with the stuff that are like 500,000, 1 million, and that kind of zone, the upper end of the mom and pop investor range. So I think you bring in a very good insight with that. But let's get to know you a little bit better. How much simple passive cash flow are you making today, and how are you kind of doing that?
Boy, it's been a good couple of years. So when I left, I worked for the government, and when I left the government, I was making just under 300 grand a year on a W-2, and I was able to escape to pass that number within my first year. I took 6 months paid vacation from the government, hammered down, and was able to get out of the rat race there in 11 months. So pretty proud of what we've accomplished.
Yeah. Was that always a hard thing to do? And like if you didn't get that severance pay, was that kind of the trigger?
I got to tell you that I was like literally shaking, signing my resignation. It's like, because you get so comfortable working for the government. I mean, I was a federal employee. I have all the benefits in the whole 9 yards, uh, 10 years of service and just under 10 years of service. And I was at that point to where I felt if I didn't make the move right then, I was never going to make it. And I could have maybe hung out for a paltry retirement. But at the end of the day, I thought I could do so much better just securing my own future, buy assets, right? And live off
Right.
the cash flow.
Right.
For us, my wife and I talked about it, we decided to make the jump. And it was scary. I mean, I just even talking about it today makes me twitch a little bit. But for me, originally, right out of the gate, Lane, the huge difference was the taxation. Massive difference. I was paying more in tax working for the government than a lot of my friends at the time made as an annual pay, which that in itself got to go right back in my pocket. So that was a beautiful thing.
Right. So before you kind of pulled the pin and left the job, what were you kind of doing up to that point?
We did this. So I've been in the business 18 years. I started as a realtor, became a house flipper. And I call it an accidental on purpose landlord. I was flipping a bunch of houses all at once back in about 04, 05. And I realized that the property values were going up about 25% per year. I'm kind of a numbers person. I like numbers. And I decided to rent all that. I finished the rehab on a bunch of houses and just put tenants in them instead. So then a year later, of course, the value went up like 26, 27%. I cashed out of all of them, sold all of them all in 1 year. Not because I thought a crash was coming. I wasn't that savvy back then. I was just greedy and I wanted to take a lot of time off and have the money to do it. So that's what I did is I sold off all those assets, but I wasn't real smart with it back then. I didn't think about things like, oh, I don't know, capital gains tax that I had to pay, which that again was 6-figure tax bill that came along with it. So, lesson learned.
Right.
Fast forward, getting back into real estate was a challenging decision because I feared that tax obligation. I didn't know what to do with that. And as I started to pay more attention to things, I realized that if I just change how I earn my money and I stop selling the assets once I get them and they're cash flowing, just keep them. As long as I don't keep them or as long as I don't sell them, I'm not going to have those big tax hits. And if I earn my money more passively than I do actively, I'm going to be taxed at a different rate. So it made perfect sense. Just go back into real estate and focus on apartments.
Right. So you're still doing the flipping or like, well, the rehab, but the hold. That was kind of the strategy.
Correct. Correct.
Oh. So I don't know if you saw the recent movie, the Han Solo movie, but this is the Han Solo question. And if those of you who don't know, Han Solo was that guy in Star Wars. Before he met Luke and Leia, he was kind of just a low life smuggler, doing whatever.
Right.
But then something happened. had this pivot point and things kind of changed for me. What was your kind of first pivot point into this world of cash flow that you had?
For me, it was I got back into real estate in 2014. I was 44 years old. I was out in the Bay of Fundy in the North Atlantic in the wintertime, freezing to death, thinking to myself, I have to do this for another 10 years and then get a retirement that I really can't live on. It's not enough money to live on. And I thought I had to figure out a change. That and my wife has a disease called MS, which is a debilitating neurological disorder, which means eventually she'll wind up with some severe health considerations that will impact her ability to travel and enjoy life and things like that. So I needed to come up with a way to earn my income, reduce my taxation, but also have the flexibility to be home with my wife when she needed me. And real estate wound up being the only thing I could come up with that was able to check all those boxes. So for me, it became a no-brainer.
So I mean, at that point, you already had the experience. You could create value. It was just kind of funneling it into the more of the passive side. Can I maybe talk a little bit about
Yeah,
what you
I
found about
see.
that?
I could create value on a short-term basis. I could find an opportunity. I'm good at negotiating. I could negotiate a great deal and turn around and flip it and make I can make piles. I have no problem making piles of money. Where I lacked the experience and I didn't have a background in was creating streams of income, streams that I didn't have to go out and beat the pavement for every day. When I learned the benefits of paper, paper, creating paper, notes, and things like that, for me, that was a big game changer. When I realized that instead of worrying about a lump sum check, for example, when I take a real estate commission, when I broker a deal, instead of taking my commission as a check at the closing table, I always try to negotiate taking my fee in payments and having the buyer make the payment. So when I put on my realtor hat, let's say, and I sell somebody a small apartment building, instead of the money coming out of the deal from the seller's proceeds, I will actually gift that money to the buyer at the closing table, which helps them with the down payment they need or whatever they need, renovations, whatever. Essentially, loan that money to them, and then carry it back as a note to mortgage, so that I can now generate streams of income that have an interest rate or growth tied to them, a yield tied to them. So they charge 6-7% interest and delay gratification for my commission over a period of years. Now I create a regular stream of income. Now my CPA and I can make a tax plan based on that makes sense. And I help people put deals together. So it creates a win-win.
So are you kind of sort of like a more of a debt investor, or is that equity? Is it a
It's
straight return, or is it like, if say the buyer is a great investor and they just triple the money in like a few years, do you get a piece of the action?
it's deal specific. So I've done both, where I've come in strictly as an equity partner. I've come in both as an equity and a debt partner, and then strictly as a debt partner. It's very deal dependent. A lot of the times I'll come in as a debt partner because the person is either a new investor or a owner occupant. They're going to occupy the property. So for them, it makes more financial sense to have me in as a debt partner, so that they can use amortization to pay me down and build equity. They want equity, whatever. Um, Other cases, I'll come in if the deal's tight or something like that, or maybe they need some expertise from me after the sale, helping them get off the ground, get the management teams in place, and set the thing up for success. I'll come in with more of a equity position. For me, I think it gives me, I have a vested interest in the success of the investment, right? I'm not just a realtor. It's not a transactional relationship. It's more of a um, longer term equity play where it's like, look, you leverage my team and my resources. I've got all the right people in my market. We'll get this thing rehabbed, rented up with good quality tenants on good, strong leases. Um, and when that happens, say in 5 years, you just buy me out of my share of the deal, or 10 years, or whatever it works out to be. So we've done those as well.
So what kind of interest rates are you kind of shooting for on your side? 'Cause, I mean, definitely that equity. I mean, I'm thinking 5 to 10%. Is that kind of the range, or?
It varies. It really depends on what the deal can afford. Number one, what I don't want to do is playing realtor is when I have my realtor head on, is I don't want my commission to impact the deal. That said, time is money. So depending on the degree of time that I'm going to invest in the deal, if it's just a transactional relationship, it's going to be somewhere around 4 to 5% of the purchase price is what my fee will be. That includes the underwriting, the due diligence, and all that. If it's where we're going to be in longer term, then we would adjust that accordingly. When it's structured as debt, it varies, and a lot of it comes down to, again, what can the deal afford? If 7% interest, let's say, on an amortized note is a challenge for them on the short term, does it make sense to maybe extend the term? Does it make sense to drop the rate and extend the term? How do we structure this debt to where it fits the deal? Because, like I said, I don't want to bankrupt the deal. I want the deal to succeed. Obviously, I'm taking risk because I'm taking a delayed commission. My commission comes at the back end of this thing or over time. So I want to make sure it wins.
Right. Right. And I'm just thinking, that a good term length might be what, 5 to 10 years or something like that. I mean, five, you should be getting something stabilized in 5 years, surely. And
Oh, absolutely.
yeah,
Absolutely.
so that's kind
We'd
of
like to keep
the
it under
normal
that.
term length then.
That's correct. That's correct.
Very interesting. Very interesting. Uh, Next question here. What's your worst life or business moment, and what did you do after? What was the lesson learned?
Oh, I'd probably say the worst one was it was a flip that went horribly wrong. We had it was a big house that we bought, foreclosure auction. It was there was three partners. There was myself and two other guys, and one of the guys brought all the money. I was the guy that finds the deals, and then when they get them fixed up, sell them. And the third guy was the contractor. Well, the contractor guy mistakenly, being this is going back many years ago, like year 2000. Oh, geez, that's a long time ago, 18 years ago. We gave signing rights to the bank account to the guy that was our third partner because it was convenient for him to go get materials. What we discovered was one day that he was actually using our money to buy materials for other jobs. So he was embezzling money from the company. When we caught him, at the time we had done a few previous flips and we had a lot of money sitting in there. Some of that money belonged to my other partner. And the guy left the country and went to England with my partners and my money, about $250,000. Then find out that he turns out he had a full contracting business with crews and trucks and the whole 9 yards, license number on the side of the truck. But we were friends and we never once thought to check his license.
Hmm.
Come to find out, he made the number up. It was a false number. He had no license. So to distract us from chasing him, he called the city and reported himself, because he's over in Europe now, reported himself as an unlicensed contractor, which consequently resulted in our job site getting red tagged. And it just opened up an entire can of worms. I mean, talking about a big 3,000 square foot Victorian house. You imagine getting red tagged by the city. We had to peel walls back and plaster and lath. It was just a nightmare.
Hmm.
We spent a year rehabbing that thing, one board at a time.
So, what was the lesson learned that you could have prevented this, or is it just kind of?
Diligence was a word I didn't even quite believe was necessary, right? Because I know people. So now it comes down to trust but verify. Everything that I do meets with some sort of verification. I'm going to be diligent. Number one, making sure that everybody that says they're licensed is licensed, but more importantly, I want to develop a track record. I don't ask them for references. I go find references. I can't find them. I don't do business with them. That simple. Also, I'm very careful about who I put in the checkbook control role. Learned that lesson the hard way, unfortunately, more than one time. But yeah, lesson learned. We were able to come out of it alive and well, so to speak, but we did suffer a pretty bad financial loss.
Yeah, yeah. Do you go as far as doing background checks, criminal checks, that kind of stuff?
We do. I use the same type of check that I do for my tenants, actually. It's a nationwide criminal history and background check. It tells us everything. Because one of the things that I've found is people that lack scruples or lack ethics, you can find that if they have a criminal record or if they have financial trouble, for example, they've had a bankruptcy, they have credit issues, they're far more likely to act, I would say, inappropriately when things don't go right, or worse, when things are going right and there's excess to be had. They obviously can't. When they have terrible credit, it shows me that they have a difficulty with holding themselves back. Right? When there's a pot of gold sitting in front of them, sometimes those people are more likely to help themselves to it.
Right. It's like
Obviously, if they didn't pay their bills in the first place.
the marshmallow test for adults.
Exactly. Absolutely.
Yeah, because you work with a lot of big deals, and I'm sure you see it too. Like usually the same people doing the deals because I mean, and they do enough deals and they're good people and everybody kind of knows each other. I think that's a good group to be around. But yeah, you got to do your due diligence, like Tyler says. You
Absolutely.
never know. Never know.
We
What's
just
your
had a
thoughts on like, the single family home world versus, the more bigger institutional investing? Do you kind of see the same, different levels of character in both, or you're
I
kind of in
think,
both worlds?
in single family, I believe that a large majority of the folks in the single family space operate from a scarcity mindset. Everything is the values of the property, for example, it starts there. They're tied to what happened down the street, right? Comparable sales. So the single family investor, number one, this is my concern, has no control over the value of the property. Really, they don't. It's the community, what goes on in the community, that controls the value of the property.
The other guy in the local RIA doing his stuff a few miles
Absolutely.
away or 10 miles away.
So by design, it's a speculation play. Whether you're a buy and hoard landlord or a flipper, it's still a speculation play because the single family market is so volatile, and it's directly tied to what goes on in the local economy. That's dangerous. That's very dangerous. Add to that recipe some scarcity mindset, people that can actually function independently. And there are people out there that can exist. I know several of them as a single family investor, literally doing the work themselves, buying the materials, painting the walls. It can be done. Can they scale? No. I know, as well as I know you do, that I was a single family guy, it's impossible to scale myself out of the rat race as a single family person. It's just not possible. Uh, that said, that's when I cut the cord and said, I'm done with the single family side. If I can't scale it, what's the point?
Right, right. There's just too many landmines of people out there.
Yeah. There's
Yeah,
landlines in the asset itself. There's landlines in all the service providers. And, on the bigger side, the commercial asset side, it's a small pool, right? We pretty much all know each other. Yes, I'm sure people out there, but we all know the same people. If we sat here and mentioned our colleagues on this episode and I rattled off my list, you would probably know 75 to 80% of them. Same both ways. It's a small world in the commercial space, and I think that it's self-policing to some degree. In other words, if we've got a bad actor in the bunch, they're not going to last very long doing what we do. That's my impression.
right, right. And kind of going back to the trying to pick out that bad actor out there. I mean, I think there's enough people doing good deals that you don't really need to go out into the abyss and trying to find that new lead investor that no one's ever heard of.
Right. Yeah.
I don't see the
Bitcoin's already
value.
been done, right?
Yeah, yeah. Yeah. So today, you're kind of working, you're still building up cash flow. Is kind of the realtor stuff's kind of the kind of just on the passive side, or is that kind of where are you putting most of your attention these days? Or is the
Most of my
realtor kind
attention.
of just a trigger to backdoor more passive investings for you then?
So for me, my realtor license, I manage a team. I've got a couple buyers agents that work with me, and I help source leads. My podcast is a great source of leads, and a lot of folks want to buy real estate from me using my criteria and the things that I do. So I leverage my license in that to monetize that end of it, so I can monetize those leads. And then I put a small team of a couple buyers agents working for me that help facilitate that. My focus is primarily raising money for non-performing notes. Big fan of non-performing notes. I've been doing that now for a couple of years with a partner out in California. We've done quite well, and I enjoy that. Of course, I'm raising money. I do have my people like you that are looking for apartments and whatnot. So we balance the two. But if I had to pick a focus, for me, it would be the non-performing notes, mainly because of the sourcing of opportunity, and non-performing notes is more plentiful. There's more opportunity over there, more stuff to look at. As you know, the commercial multifamily space, there's only a handful of decent deals running around, where on the note side, there's a lot more out there.
Right. And I'm actually a pretty good believer in the notes. It's just I haven't dived into it. I know, we were talking about engineers. A lot of my podcast listeners are engineers, and I'd say, once people do the single family home thing, they graduate to bigger things. The non-performing notes is a big space for engineers, because for a lot of us that live in California or Hawaii or places far away from the actual deals, non-performing notes are actually a pretty good, nice way of going about doing this. You've got that servicer in there, no tenants, termites, or toilets, and it's a data-driven thing. I don't. You're probably a lot further along than the normal guy looking in. But from the outsider's perspective, this note thing looks very fragmented, and it's hard to figure out, well, where do I buy the notes and that kind of stuff. And it's
It is.
probably a good opportunity.
It is. What you'll find is it's two ways. So it is very data driven. You're absolutely correct from the analyzation point. From the point of actually acquiring the right notes and being able to make offers and get them through and get accepted, it's very much relationship driven. That's the beauty. I like to analyze things. The devil's. I'm not a details person to the degree of being an engineer, but I want to know what I need to know. I'm very focused on what do the numbers say, what do the stats say, what's the likelihood, and what's the risk model in this. My partner Paige, although she is a details person, what her best suit is building relationships, one-on-one relationships with banks and asset managers. So she can build new relationships on a one-to-one level, frankly, better than I can. That being her strong suit, she helps us source the opportunity of finding the notes. I, of course, communicate on a larger scale, but having a podcast and things like that. So my job in the mix is raising capital. But it takes both. It takes the ability to analyze that data, but it also takes the ability to make sure that you're able to buy great opportunities, because let's be honest, there's a lot of industrial institutional capital out there that kind of is can be a competitor to us. So there's a big gap between us and them, and there's a very big area in the middle. So what you'll find sometimes is that we may go a month or two before we find something worth pulling a trigger on, or we look at a tape and the assets on it are just a mess. In that case, let's say we made a low offer on it, right, to hedge our risk. A large industrial or institutional player will come in and make a far more aggressive offer, because they don't have to show the type of yield that we do. Right? Them a 2, 3, 4, 5% yield would make sense. For us, that we'd think that doesn't work for us.
Right, right. You're the more agile, smart mom and pop investor that's looking for a good double-digit yield, whereas at a stroke of a pen somewhere in some boardroom, they're kind of like, well, we're going to buy this type of note.
Exactly. But the thing is, the problem with notes, I'll be honest with you, Lane, is there's zero tax advantages, and in fact, it creates a taxable event. Um, so from a tax perspective, it's for somebody that, like an engineer that is a high W-2 income earner. If you're going to play in the note space, you certainly better have some real estate in your portfolio to offset that tax liability. If you don't, I mean, I'm no CPA, but I would first get with a good CPA, because it would be like flipping houses and winning a lot more.
Yeah. Or maybe we should team up on like a oil and gas investment and just go
Right.
out and and create deductions.
There you go.
Yeah. There's something that you recently thought about burning your cash on, maybe for like a time savings or improving a quality of life.
So I recently bought a piece of land up north of here where I got a cabin on it and whatnot, and about 25 acres. That's my like hidey hole. I hide away there on the weekends. It's great. The phone doesn't work out there. It's out in the middle of nowhere. And I'm at the stage to where, do I want to keep it really rustic, or do I want to make it like this gorgeous retreat? I can do either one. I just can't decide which one I want to do. And my wife has no help helping me decide. But,
So you're not working on the weekends, and you just kind of go up there and.
no, I work Monday through Thursday. I usually take Friday, Saturday, and Sundays off.
Interesting. It's something that you recently changed your mind on.
I would say arbitrage. I'm a guy that I'm always focused on streams of income. I say that being a note investor, but truly I am. When I have a win from a note investment, then I look at how can I take this amount of money and leverage into something that will provide streams. Deal sourcing has been low, so I have been looking at some opportunities that would normally be smaller than what I want to mess with, mainly because when they present themselves, if they're great deals and they provide that perpetual cash flow, kind of why not? So normally I would have just ignored those and just kind of focused on other things, but I'm starting to look at more of those opportunities to create more streams of income. Another thing I never thought I would look at before is small businesses. I'm starting to look at investing in some small businesses, different types, just to kind of spread things around a little bit.
Yeah. Are you kind
Offset.
of looking to bring in a partner on that to kind of be your expert to walk your hand down that road, or?
Yeah, absolutely. I'm not obviously an expert in all things. So what I would probably do is be the money partner to invest in somebody else's business to where they were an expert, maybe just need the capital, the infusion of capital, maybe a little bit of direction as far as entrepreneurship and things like that or marketing help. But outside of that, I want to be hands off. Really do.
Yeah, yeah, and it definitely seems like, I'm sure you kind of go around to the same conferences and meet kind of the same people, but maybe about 5 or 10% of these guys, you kind of dig into their story and you find out that they just happen to be a owner of some kind of, you know, more smaller business, like whether it be like an ink and jet store or like a paper printing. Like it's like, well, where did this come from? Right? It's so weird, but a lot of those guys are kind of going back into their business side now that deals are kind of scarce, and that's their highest and best use, and they're kind of going back to where they came from. Obviously, that's probably why they're in real estate, because real estate is probably one of the best places to place more money into more passive activities and going the business route. But I don't know, have you been? I mean, that's probably how you're meeting the people, right? Like, the same
It
way.
is. And I spend a lot of time speaking locally in my market and speaking around. I've spoken at different conferences and things like that. And when I meet people, I really like to engage in them and figure out what makes them tick. Why are they here? How did they get here? And the one common denominator of the people that I see that are the most successful is they're just simply willing to take on larger chances or bigger chances than other people would, and willing to follow them through. They also don't put all their eggs in one basket, right? Kind of like we invest all of our time into our job, right? Some people do that have a job. Um, and then at the end of the cycle, they turn 65, and the plan is to retire and live on less money. It doesn't make sense. For me, the buying the businesses is put a little bit over here, a little bit over there, let those things work themselves out. But I like the idea of being able to help other people get financially free, the business owner or whatnot. So for me, that's a big push. It's part of my why.
Right, right. Yeah, I also got these other friends that have invested in a play, and I guess that play kind of blew up on them, and they're like, "Yeah, that's one of our best investment. I mean, we put barely anything, and we're getting this big check every month." I mean,
I have a client that does that. She makes a killing. Yeah, she's turned seven figures investing in theater.
yeah.
Who knew? Right? Pizza joint, right? Read Rich Dad Poor Dad. What do they talk about in the cash flow game? A pizza joint. Have you ever looked at the financials of a pizza joint? You should, being an engineer. It'll blow your mind how profitable they can be. It amazes me. How often do you think of a pizza joint going out of business? Unless they're a big chain, very rarely. The mom and pops are in business for an eternity.
Yeah, I've never heard of people saying that was bad pizza. It's always good pizza, even though it's terrible.
Exactly. It may kill you, but it's highly profitable.
Yeah. So do you have a certain like asset allocation, like 10, 20% of your all your portfolio into like more active businesses, or that you're trying to eye, or at
We're
this
looking at
stage?
about 25%. So we escaped the rat race back in 2014. My wife, at the time, actually about a year later, got laid off from her job. We escaped the rat race. She just still chose to work. Part of that choice was the medical insurance. Where she works provides medical insurance, and that's a big plus. Her having MS, she's got a debilitating disease. We needed medical insurance. So although she was still working, it was more by choice than financial necessity. That said, now we're at the point to where we're getting ready to phase her out of the job altogether. Still, we're very diligent about putting money away, and that runs about 25% of what we're at. It fluctuates from time to time because I'm self-employed, so sometimes we have different things. We do arbitrage. We have good months, bad months, whatever, but we always try to stick to that 25%.
Okay. Okay. So in this seller's market, this is going out to like one of the newer guys out there. They're still working a day job. They may have some money saved up, maybe like 20 grand, 40 grand, maybe even 50 grand of liquidity that they can take out from a self-directed Roth IRA or something like that. But for someone who doesn't have the experience nor really the network, what would you suggest they do at this point in the game?
Depending on if it was cash or IRA money, if they have the ability to open some sort of a self-directed IRA, I would first tell them to go Roth, because the one thing we can all agree on is that taxes are never going to go down. So you might as well just pay your taxes now and then enjoy tax-free growth for the rest of your life. That's just my personal opinion.
Right, I
A lot of
agree.
money,
Or just
a lot
take the damn money out now and be done with it.
let it grow. Exactly. The second thing would be, what do they invest in? You think a lot of people think, well, I don't have enough money to do something. Well, you do, because here's the thing: you can leverage other people's resources. A good example of that is, let's say you find somebody that's got a duplex, and there's a lot of properties that are free and clear that don't have any debt. You can leverage that free and clear asset, giving that seller payments for equity. I actually teach that on my show, on my podcast. Is go in, negotiate seller financing, use what money you do have as a down payment, light renovation, let that grow, build that foundation, and let that grow over time. If it's a retirement funds, great. You can create you can turn around and hold it for a couple of years and then turn around, sell it on terms, take that note and mortgage and trade that note and mortgage, or trade that note rather, that's as collateral towards a larger asset. You don't have to wait for them to pay off your duplex. If you buy it for 100, you sell it for 150 5 years down the road. Take that $150,000 note, use it as a down payment on a 20-unit building. Keep scaling like that. Because the one thing a lot of people want when presented to them properly is a predictable stream of income. What better predictable stream of income than a note secured by real estate in first position on a good asset? That's a home run.
And most people kind of get tied up over the legal stuff. And is that something that a closing attorney can do for them? Or
Absolutely. Any
just,
title company in the country or closing attorney can handle that transaction. Is ridiculously simple.
and how much does that usually cost in terms of legal time or costs
In
for
my
them?
market, a title company will do that as part of the transaction without any extra charge. I've done it at several title companies. I've never paid any extra. An
Hmm.
attorney may ding you for an extra hour of labor, whatever that is, their hourly rate, 300, 400, 500 bucks. Regardless, no matter what it costs, it's worth it. It's well
Yeah.
worth it.
Yeah, no, I like that strategy. I mean, I think a lot of the listeners, they've got a full-time W-2 job, but a lot of them have the realtor license on the side for no good reason other than they at one time they wanted to have access to the MLS. But to be able to kind of go in at closing and instead of taking your $10,000, $20,000 commission check to stuff it back in the deal with a seller note adds more value to like you said the buyer. Sometimes they can probably get in with actually no money if you do that.
They
Um,
can in a lot of cases. Yeah.
yeah. But yeah, definitely good stuff to think about.
There's really, I believe that anybody pretty much that has the desire that's strong enough can get started in real estate investing without much of their own money. There's so many different ways you can leverage things. There's so much that's negotiable in a transaction besides the purchase price of the house. The title, the closing costs, the lender fees, all these things can be negotiated as credits. Uh, you got to remember, everybody in real estate transaction for the most part is on commission. That gives you leverage, the ability to leverage things. I did my first deal with literally not one penny of my own money, using a VA mortgage, no closing costs, no nothing. I walked out of there with a check for $1,700 in rent credits.
Hmm. So I think something that I'm still scratching my head out around is I know that there's different fluctuations in this. So you go to the closing table as the agent and you may be getting like a $10,000, $15,000 check. What where do you start out with the terms? Of course it's very negotiable, but what's this fair starting ground to ask for? Like
As
a
far as what my commission would be,
Yeah, you stuff the money back in the deal, but you take what, a 7% from that or 8% from that for a 5-year period or
generally that's kind of where I'll start. What I find is a lot of my clients are payment shoppers. So we try to match the what the terms of the note are to what the payment they feel is affordable based on their cash flow number.
So if they're getting like a 5% interest rate, you would match it 5 or maybe 6 or.
Not necessarily, because first of all, I'm not in first lien position. Therefore, I have increased risk, right? Not being in first lien position, I'm automatically going to command a higher interest rate because of risk, purely because of risk, than Bank of America would be, let's say.
Right. So that puts you around 7 or something in
Yeah,
that
7 to 8%.
vicinity, 7 to
Right.
8%.
And then we'll change the term to fit whatever the buyer needs as far as the payment. So let's say payment's $100 a month and they don't feel comfortable, they can get the cap rate they need and all the different things that they need. The cash on cash return with my $100 built in there, and maybe that number is $75. Then we'll extend it out a year, 18 months, or whatever it needs to be to get that payment down to where it makes sense.
Okay. And this is mostly on investment properties. You're not doing it on anybody's home sales or primary
Oh,
residence.
absolutely. We do it on both home and investment.
Oh, okay. Okay.
What we found is that we cannot credit the only thing when we credit our commission to the deal, it has to go to closing costs. It cannot go to the down payment because
Got it.
most uh, residential lending programs do not allow that to happen. The down payment has to come from somewhere else. However, seller credits, and things like that can all accommodate.
Right. I think the seller credits is what, 6%? That's the maximum now.
Depends on the loan program. It's between 4 and 6%, depending on
Yeah.
the loan program. VA, I
So
think you can go up to 6%.
so if you can get 6%, you as the broker can probably kick back another 3 to 4 or something like that.
Yeah, absolutely.
And that's how the buyer walks away with nothing in there almost.
Right.
Got it. And then are you in that deal for a long time, or do you like to kind of get out in 5 to 10?
It depends. When I'm doing that, I'm in the money lending business. I don't want to have to foreclose on somebody and set things up to where they won't succeed. So for me, it's strictly a loan is what it is. I'm focused on the return. So I want to set it up to where the payments make sense to allow them to succeed. I don't want to under 20, 30 grand. I don't want to have to go to foreclosure for that little amount of money. It's when you apply the cost of a foreclosure at $3,000-$4,000 to a $10,000 note, that's 25%, right?
Not worth it. Yeah.
It's not worth it. So I want to make sure I set it up to where they win, where they can succeed. Because if they succeed, I automatically succeed.
Yeah. Definitely a good way to help out, friends and family, especially if you're helping them buying their property. You can kind of help them on this facet, and then, you're not really doing it for the money, but you're definitely helping them on the front end. And it's not like
It's a growth play.
yeah, yeah.
Yeah.
So we've got the final question here, and this is the Tony Robbins question, where he always talks about two main things, which are the art of fulfillment and the science of achievement. So to kind of break that down, first, what's your secret or hack to the science of achievement? Any secret habits or quirky things that you kind of done to get more stuff done and kind of get to where you're at today?
This is going to sound bizarre, and nobody's probably ever told you this before, but when I was in the military, they had these notepads called Write in the Rain, right? Little notepad, and you can
Kind of
literally
expensive books because
they are,
yeah.
but bear with me, they're worth it. I keep one in the shower because I have some of my greatest ideas in the shower, my greatest epiphanies. So literally, I'll be in the shower, I will stop, covered in soap, and write myself a note. And then when I get out of the shower, I can do it right in the shower. I don't forget things, because how many times do you have a great idea and you're not in a place to write it down, and then the next day you're like, "What was that idea I was talking about?"
Huh.
So I implemented that, and it's been a game changer. It's like, whoa, it's so
they,
much more done now.
they have one of those they used to have them at Costco where you write it on it's like a newer age sketch pad
Right?
where you kind of write. I used to use that, but the heat doesn't really work too well sometimes, or it got screwed up. Like, I think the battery got wet, but I
Oh,
like
yeah.
your idea of writing the rain. But the pen doesn't get wet, or is it a different
Pen is
pen?
designed for that. They sell a pen to go with it.
Oh,
The little ballpoint pen. It's got a cap that snaps on, and yeah, it's
right.
fantastic.
And then you got the tearaway booklet.
Yep, absolutely.
Oh, oh, awesome. I like that.
It works.
Now, secondly, what's the secret or hack to the art of fulfillment? How do you keep being happy? Because it's always, more and more money, more and more bigger things, but how do you kind
I
of
have,
pause?
I'm always fair to myself. In other words, last night, for example, I do a coaching program, group coaching program, and I'm up those nights. I give a ton of value. I'm on the phone with people for like 2 hours, and we start at 8 o'clock. Sometimes we go till 10:30. Well, I worked all day yesterday too, right? I was engaged doing other things all day yesterday. So I worked more than what I would normally like to work. So I will take, after we're done today, I'm going to take a couple hours for me. And one of my big passions is personal development. So one of my greatest enjoyment is great cup of espresso. And I'm going to sit down with a good book that I want to read for me. And I'm going to take that knowledge in. And for me, that's like one of my favorite things in the world.
Is this on
Help
like
a person.
the days off working, or is it kind of within the madness of the work week?
It's within the madness. On the weekends, I completely unplug. I got that property up in the woods, and the phone stays in the truck for the weekend, and I go out and walk in the woods, and I do a lot of photography and things like that. I'm totally off the grid, nice sustainable little property, and I'm just in heaven up there. So that's my unplugged time.
Well, all right. Well, anything think we missed? Any other lasting messages? You want to get your contact information out there for folks to get a hold of you?
Yep. Best way to reach me is my website, cashflowguys.com, cashflowguys.com. I have a YouTube channel under the same name. I put out a lot of free education for people to help them get going. My podcast is on both YouTube and my website, and of course, all the other places, Libsyn, Stitcher, iTunes, all that good stuff. So just anywhere you go, just type in cash flow and then guys, and you'll come right to me, and there, you'll be able to take all the content in.
Well, oh yeah, and everybody says, well, Tyler kind of does what you do, Lane. It's like, well, so I think personal development, all those guys, it's all the Think and Grow Rich stuff regurgitated by different people. So I think you just gotta find people that you resonate with, and that kind of says it in your language. And it might come from different people, but I think
Absolutely.
at the end of the day, I mean, probably gonna work on the same type of deals or same stuff. And I always think about diversifying into all kinds of stuff, not just apartments or one thing or another, but maybe even non-performing notes.
I agree 100%. You ever need help with that? Let me know.
Yeah. Gotta write a note.
There you go.
All right, Tyler. Well, thanks for coming on, and you guys make sure you guys go to the website, sign up for the that bi-weekly newsletter because I don't have enough time to do it weekly.
There you go.
All right.
Thanks, Lane.